So this is the middle part of our discussion on early stage valuations. Um, I'm going to talk about pre-money valuations. I'm going to talk about post-money valuations. The perspective for pre-money valuations is from the entrepreneur who's asking how much money have I built in, how much value have I built into this company, and then add to that the investment amount to determine a post-money. The investor's perspective is how much of this company do I want as a percentage in exchange for the money I'm going to give them, which determines a post-money valuation. Subtract the investment amount from the post-money valuation and you arrive at the pre. So you have the entrepreneur and the investor going in two different directions using different methods. You need to understand both directions and the techniques that are used in both those directions so that you can reach a negotiated value of your company sooner and reach one that's fair for both you and the investor. So there are a lot of different factors that can affect pre-money valuations as your company, and those really are the ones that you have the most control over. So be focused on those things. I've talked about milestones and validation and showing that you've removed uncertainty from your startup. Those are things that'll make your company more valuable and reduce the perceived riskiness of your venture as an investment vehicle for your angels and your venture capitalists and your friends and family. Deal factors are the ways that you approach the setting up a deal to determine a pre-money will affect it. The macro environment, we're talking about the economy, the availability of money in terms of funds that people have to invest in a company like yours. And then local environment factors like deal flow, knowledge of other companies that we call in the lingo comparables that people can use as comparisons to your business. In a town like Tuscaloosa, there aren't many angel investors. There aren't many comparable startups to maybe something you want to get going. And so you're going to have to do some education on that side. Founders and team, are they experienced? Are you building into a very large market? Do you have good looking but reasonable revenue projections? Is your technology state of the art? Can you protect your intellectual property? Are you going to be able to grow for a while without attracting competition? Do you have revenues and customer traction? Do you have something that's an attractive exit potential? And just as an aside here, most of the exit potentials these days seem to be, oh, we get big enough, then Facebook or Google or Amazon or Netflix can buy us. And that's kind of a reality of where we are. That's a macro factor. Hopefully, we're moving into some sort of disruption of big tech where they can still provide the value they do, but there are other ways for entrepreneurs to get attractive exits without having to sell out to those companies. And then boards of directors and advisors. The deal factor. Um, your expectations and assumptions about the value of your company need to line up with your investors' expectations for ownership. You'll see what those are when the investor shows you the term sheet with all the deal points. They'll most likely get preferred share rights that make it less risky as an investment. The preferred shares mean that they might get what they call participation, where they actually get the full amount that they invested in you back. And then after they subtracted that from the pie they're dividing, then they'll take the percentage ownership they have. That's much less risky than the common shares that your friends and family and you own, and the stock options your employees own. If you've already got money that people have invested, that's good. If you're later in the stage of the startup, also good. And if you're going to need additional investments later on, just let your investor know. Make sure you understand the milestones and the costs you're going to need to incur to achieve those. Industry trends, economy, political, regulatory, so much uncertainty with these. The good news is they affect everyone. The bad news is they affect everyone. So if you can find a way to use any perceived sack of lemons as being useful to create lemonade, then that's going to be to your advantage. I talked about comparables in terms of local environment factors. Are there other startups like yours? Have they raised money successfully? One of the phenomena that we have going on not far from here is the medical and healthcare technology uh, ecosystem up in Birmingham. There are startups in healthcare, analytics, technology, hardware, a, a lot of things that are coming out of the research being done up there in the community. And so there are more comparables for early stage investors to use to get a more precise estimate of how much your company's worth. There are also recent exits, maybe not necessarily IPOs, but companies that have been acquired. And so you want to have some high quality investable startups in that ecosystem, but you don't want to have it so saturated that you're all competing for a finite number of investor dollars. Okay, the founder's perspective, pre-money, how much is my company worth? So here's some early stage valuation methods. Market comp, the simplest, the one that most people like to use. Step up, risk mitigation, and then these are not pre-money, but post-money from the venture capital or investor standpoint, the quick valuation and evaluation method. So you're going to learn how to combine these different methods, use them as standalones, use them as ways to triangulate your location, if you will, so that you've done different pre-money and post-money techniques. And now I can kind of settle on a number that seems like it's the average or where all the other numbers are pointing to. But always be ready to answer the investor question, how did you arrive at this valuation? Don't worry about share price, work through the valuations, and then once I have a reasonable pre-money, I can think about my investment amount, and then I'm looking at the percentage of ownership that the investor will get based on that formula. Market comps. It's quick, but you have to have data for that. So you're going to look at other companies that have closed deals or about to close deals or have some other form of information that's made publicly available, or at least you know about it. You're like startup X and it was just valued at 1.5 million pre-money. So your startup must also be in that same pre-money range. This is a lot like real estate. The last house in your neighborhood sold for X hundreds of thousands of dollars. So yours is probably going to sell for about the same. The comps give additional valuation for the investor. If it already happened, however rational or irrational, it means that several things must be true for that valuation to have been arrived at. So they're going to say, there are other startups out there getting funding like the one I'm considering, so my investment might be safe or even profitable. That's the narrative they're telling themselves when they're using comparables. It's the most straightforward method. You can go into Crunchbase and look up companies that are similar to yours. You can kind of infer their valuations based on what series of investment they've done. For a seed, you can think anywhere from 10 to 16 to 20%. For a Series A, usually it's around 20%. We'll get to some of that in the future discussions of these techniques. Make a profile of your startup, find startups similar to yours, compare your profile to the comp's profile along a bunch of different metrics. Like this one, what industry are you in? What's the niche? Do you have experience as founders? Location does matter. Do you have paying customers? What type of business model is it? What's your stage of development? Do you have previous funding? Is your team filled out with experts who have previous experience? And you'll use all those to kind of back into a number based on comparisons of each of those attributes to a startup that has a known valuation, and you can estimate all the other attributes of that startup. AngelList, Crunchbase, Hacker News, Gust, use them all, follow these links. There's a more filled out example of a startup profile. You'll want to adjust your comparables valuation for large and obvious differences. This is not an exact science. None of this really is. It's not getting the math problem right. It's building a case of powerful narrative for your valuation. And if you're going to make a difference and make a change, then make a note why you did that. Always be able to discuss those things because they're the first questions you're going to get on valuation from an investor audience. More considerations, and this is back to the macro environment, or I'm sorry, the local environment. If there's a lot of deal flow in a particular place, they're going to be more reliable comparables, and the investors will have a much more confident view of your valuation because of the strong deal flow. So in this case, especially where there's a lot of deal flow, getting to an agreed upon pre-money valuation is going to be pretty quick for experienced investors and entrepreneurs. The step-up valuation method. This is a check the box method to get the pre-money valuation. It's granular enough so that I can take credit for different categories of accomplishments and not have a no answer cut off a huge amount of valuation that maybe I could have deserved part of. This is inspired by Dave Burkus from over 20 years ago, where he used check marks to give credit to the entrepreneurs for having a good idea, a good management team, a working prototype, a quality board of directors for good company governance and oversight, and traction with good product rollout and sales. 5 categories, adding up to a max each of $500,000 with a total possible pre-money valuation of $2.5 million. That's even a bit high. You're going to use numbers in between 0 and $500,000 million for each of those. We'll see as we move forward here. Here's a variation of that in the step-up model. This one that Stephen Poland uses in his book on valuing companies, which you should get, has 10 step-up factors, each worth $250,000, I believe. So that's $250,000 post-money. I'm sorry, $2.5 million post-money. Market size, scalable business model, founder experience, full-time founder team, minimum viable product development with customer development, validated business model, and validated almost always means that customers are paying for your product, significant industry partnerships, an execution roadmap, which means that you understand what your next milestones are and what you need to achieve to further validate your business, intellectual property issued and protected, and a competitive environment that's favorable. So there's 6 check marks for this example. Times the $250,000 will give you a pre-money valuation of $1.5 million. So you can see, based on what I just did, I just ran through an example of that. It's $1.5 million. The figure on the right shows you why it's called the step-up method. If you can get to the top of that, you're going to be like Rocky and have a pretty good pre-money valuation. So those are the main categories, but if you have something that you think is a critical factor that adds value to your business, then substitute that for one of the factors in the list. But also make sure it's defensible to your investors. Attracting an all-star board of directors, as Dave Berkowitz says is a big deal, might be something that can really help push your company forward. Some investors consider those box checkings all or none factors. Go for partial credit, like when you negotiate your exams and your classes. This is the Berkus method. I don't know why I'm thinking of Berkowitz, but the Berkus method assigns a number, a financial valuation to each of those 4. Those are $500,000 caps for each of the categories. Try to reach those as milestones, and then work out in your own mind whether or not each of those is worth $500,000 in value to your company. So there aren't any exact rules for establishing early stage valuations using the step up method. Just be able to explain your valuation and your underlying assumptions. Third category, we've done comparables, we've done step up. This is risk mitigation. Recall that you build value into your company by reducing risk and uncertainty associated with it. So, does your technology work? That's a big deal. The customers care and they want to buy it. Are you selling vitamins or painkillers? Because if you're selling vitamins, then it's something that'd be kind of nice to have. But if I'm selling painkillers and people are standing in line to buy what I have to offer, execution or experience in a segment you're targeting, a person on the founders team who worked in corporate sales in the same industry is going to have a deep understanding of how that industry works and a track record then. And the founders invested personal funds. Have you gone out and raised friends and family? Did you do any type of crowdfunding to further validate your product and add revenues and cash to what you're bringing to your negotiation now with an investor? This one is the most specific to your venture and how you validate your hard-earned milestones. So as this one shows here, how do they get to these numbers? They used very specific to the company methods of valuation for technology, execution, market, and capital risks. This all adds up to a $935,000 pre-money valuation, which sounds like fantasy accounting pro formas. Keep in mind that these aren't the costs the startup incurred. These are the value to the startup in terms of pre-money, of what value the startup's bringing to the negotiation table when you talk to investors. What's the advantage? I can take credit for my smaller victories. I can take credit for my big victories. I can take credit for all the work I've done to build value into my company. Step by step, use each of the four categories. It's like creating a resume for your company. Assign values to the different tasks and accomplishments within those four categories. Put in some value multipliers if you think that's what they deserve. For example, lifetime value of monthly paying customers is a big deal. Add it all up, you have your pre-money. So you can be on two extreme sides of the bell curve with this. One of them is you can have a lot of accomplishments, but a low pre-money number. You might be undervaluing all those accomplishments. On the other side, you could be just in the idea stage and magically have come up with $1 million pre-money valuation. Overvalued, go back and do your work again. So there's more on technology, especially if you look at R&D considerations. Am I creating a significant barrier to entry because of the uniqueness of my research and development and the technology I'm creating from that? It's also possible that I could be investing in research and development to produce an innovation that nobody wants. You might have noticed or heard that they stopped making Segways. Good for them. It's an innovation that doesn't necessarily have a market. It looks like people are on scooters now. So a pro tip for all these things is there really are no pro tips. The risk mitigation approach is an exercise that's really worthwhile for your company to consider using to try to back into a number for your pre-money valuation, knowing that those are your opinions, however hard considered they are, and that other people have other opinions. So we have two different methods for the venture capital post-money perspective. Remember that they are thinking about how much of the company they will get as a percentage of ownership in return for the money they're injecting into your company. The VC quick valuation method is very quick because it only needs a few inputs. The venture capital investor figures out how much money you need for the next 18 months, and then they put that in, usually with the assumption that they'll get 20% of the company, and then they'll calculate the post-money based on that. They'll subtract out their investment from the post-money they just calculated, and that'll determine your pre-money. So let's say you need $3 million to fund your operations for the next 18 months. VCs want 20%. $3 million for 20% of a company equals $15 million for 100% of the company. The pre-money is $12 million. And at that point, you should be doing a reality check. Wow, did I just build $12 million into my company? Because my risk mitigation just told me it's about two. So you're always doing reality checks with these approaches. These are all things that you should be considering if you use this method. It's quick. It's something that gets you to a number very quickly. The rule of thumb to use here is that venture capital investors are looking for a value around 20% with a margin of error. If it's less than that, it's not worth their effort. And if it's much more than that, then it's too much delusion for you and your earlier investors. So it's not really useful for very early stage startups. That's a consideration. If you're ready for Series A money, then it could be very useful. This is the VC valuation method that relies on more financial assumptions and focuses on an exit value of your company using an expected return on investment, or ROI, that your venture capital angel investor will use. So there's a lot more going on here. Let's walk through the steps. So we're starting with exit year revenue or exit year earnings, whatever the metric's going to be, because we're going to apply an industry standard ratio like a price to earnings ratio or price to revenues ratio. Here we have exit revenue in year XXXX of 20 million. If we apply a price to revenue multiplier of 2, then the company at that exit year is worth $40 million. If we then use the desired return on investment of 20, which seems to be standard in most of the things I've looked at, then we divide this 40 million in future value by the 20 to get to the present post-money value now. So we're still talking post-money. If I subtract out the investment amount, then I have my pre-money valuation, and then I can predict or calculate what the investor equity ownership is going to be. So I just went from $20 million in exit revenue to a $1.5 million pre-money valuation, and I'm giving up 25% of the company. So just like Stephen Covey with his 7 steps for successful people, begin with the end in mind, start at the end and work backwards. It's an acquisition or an IPO. Work backward through the assumptions that must be true for this to happen, using something like very measurable like annual revenues or earnings. Incorporate those return on investment expectations. If the venture capital investor doesn't think the startup can get a 20x return on investment, they're not going to invest. Make sure you understand the equation. Whatever future valuation number you're looking at, whether it's revenue or earnings, use the appropriate industry multiplier, then use the return on investment they expect to get from a future valuation to present day post-money valuation, subtract out the investment amount to get pre-money, and then divide that investment amount by post-money to get the percentage that the investors are going to take for this deal. You can flip the equation to solve all kinds of problems. Invert, 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 always invert. These are just more different ways to look at it here. This one uses earnings before interest and tax expenses. I'm using ratios here, not only of the price to earnings, but also of what my interest expenses and tax expenses are going to be. And you can read through the rest of this. So here's the thing. You're living in the present and the future. You're raising $500,000 now and knowing that you need to be acquired in the future for at least $40 million. Hold those two thoughts in your head simultaneously and you'll be okay. One thing to understand here for this particular method, you've got to be able to exit for the dollars that you're using for that acquisition amount in the number of years that they're expecting with the return on investment they're expecting. If you break any part of that, then you're not going to get the investment, at least not through this VC valuation method. Okay, so that's it for the valuation methods. I understand this is a long lecture. Play it over, play it slow, play it fast. My voice sounds great at any speed, and I hope that you can apply these different methods in many ways to make them useful for yourself.